Hey everyone, hope you're having a good day. My name's Andy. My channel is Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in there, take a look, see what people are sharing. If you want to follow me, it's at Finding_Finance. And if you want to join our community, finding-value.com. We just went through a question and answer session talking about basically the cycle that we're going through today and comparing it to previous cycles, the inverted yield curve, potential slowdowns, recessions, and previous ones. We talked about all that stuff. It's posted on the website if you want to view it, and we do have a discount coupon code. It's discount. That's the coupon code. And you can save on the monthly membership, and you can also save on the yearly membership, a larger discount if you'd like to join. So I was looking at some stuff on TradingView. We will be doing a TradingView tutorial on how to use some of these features on the software that they've got. So that will be coming up at some point soon. I haven't got the exact date. I'm trying to get through the Christmas timeframe and New Year where more people might be able to attend it. So here's gold in different currencies. I wanted just to show that gold is the thing that is stable here. Gold is 1 ounce of gold, and the currencies are adjusting around gold. That's the way that I view it. So these charts moving up is really the currency moving down. It's the denominator that is changing in these charts that I'm swapping out. So we had a consolidation from about 2012 and then a breakout here in 2019. And we're seeing another big move in the currencies going down against gold. This is the Australian dollar. This is the British pound. And again, we had a breakout in 2019 where everything is just ripping higher, currency-wise, ripping lower against gold. Gold versus Japanese yen, this thing's been ripping since 2019 as well. These are big moves, guys. This is down at 150,000 is what I see there. And it's well over double in this time frame over the 4 or 5 year period, up to 410,000. And this is the Canadian dollar, and that's ripping too. 07, 08, 09, all the way to 2011, pretty big rip in there. We consolidated for a little bit and broke out in 2019. Big breakout, a cup and handle pattern that's broken out here. This is also a cup and a handle. So the consolidations, which more than likely is the currency consolidating, the consolidations are cup and handles, inverted, shoulder, head, shoulder, but they're cup and handles in this case. Whenever you lead into it coming up, it'd be a cup and then your handle and then the break and another cup handle. They're just continuation patterns. I also looked at silver because I like silver. And silver in relationship to gold, when you remove the currency from the mix, that's what ratios do. We just looked at all 4 of these different currencies and pricing gold in those currencies. What is floating is your currency. Gold is the stable unit of measure, while your volatile unit of measures are moving against that stable unit. What I do know and why I use ratios is because I can extract the Australian dollar, the British pound, the Canadian dollar, the Japanese yen, the United States dollar. I can extract all that out, and then I price gold versus silver, gold versus platinum, platinum versus silver, palladium versus gold. I can do all of those measurements, compare them to history to see what is actually cheap and expensive. You can't use any of these currencies as a reliable gauge to measure the value over time because the currency is moving on you. So what I do is I extract out all of the currencies and compare assets against each other. And that gives me a clearer picture of what is cheap and what is expensive over long periods of time while removing a variety of currencies. Silver in a variety of currencies here, the same ones that we are looking at. So this is the British pound priced silver. We kind of get this cup pattern, the handle, and then we're breaking out to the upside. This looks good. Nothing bad there. Silver versus the Japanese yen. We kind of had a squeeze down into the corner of 2020 where this kind of came to this dead period, broke out, and then we had, the COVID crash. Ever since the COVID crash, it's been game on, baby. It's been game on. This low here was 1,500, and now it's at 4,614. This is silver versus the Australian dollar, another kind of cup handle formation and a break to the upside. So everything that I'm seeing is breaking resistances to the upside. They look very, very good. And then silver priced in the Canadian dollar, another big cup and handle that's broken to the upside. And these cups and handles, they're not as big as the United States cup and handle going back to the 70s, 80s, 90s, like that huge cup and handle. These went from 2011 cup, and then the handle was formed from 2021 onward. We've broken out here recently. And maybe that has something to do with all of these different countries lowering interest rates. And then I'm sure these front ran the lowering. So they all have these cup and handles that have broken to the upside since 2011. So they're big cup and handles, and everything looks good on all of them. Here's some housing data. I haven't gone over a ton of housing data in a lot of these. So this is housing starts over a long period of time since 1959. We've been squeezing up against the average housing starts, which is about 1.3 million or so. And we're squeezing right up on top of it. Will this break higher, or do we still have further downside? I think if rates continue up, we get further downside. If rates drop, I think housing starts will take off. We had a very similar situation in 99, 2000, where we squeezed up very similar to what we have today. They lowered rates, and then they went bazooka on their loaning deals. Like they were just loaning to everyone. They took the bazooka out and just gave loans and fired it all over the place. And this was the housing starts under that time. Big move higher. So are we going to get something that's similar, that we get another big move higher? We have about, at least from what I read, we have somewhere between maybe 3.5 and 7 million home deficit, depending on what data you look at and what numbers you use. The deficit is there, but the affordability is not. So what that means is that families have formed, but we don't have the affordability for them to necessarily afford the house to purchase. And that's where the mortgage rate comes in here. So that's what we see in the housing starts. U.S. construction, all employees. Generally, the recessions come from employees losing their jobs, and it comes from construction, the real estate cycle. So you can see the pullback, 75 pullback, the pullback in the 80s. There's a small pullback right before 1970 in the late 60s there. We have a big pullback in early 90s. That caused a recession there. We had a pullback in 2000, 2001. We had a monster pullback in 2008. Well, it started in 06 and ended in 2011. That was a really, really disastrous pullback. But right now, we don't see that pullback. So are we going to get a slowdown or not? And it's very possible, and this would be something that you'd want to watch. This is total construction spending for residential in the United States, and it's still going up. It still looks okay, but we had this monster move down in 2022. Now, this could have been the slowdown here. The slowdown and then the move higher. We had a decent sized slowdown in 2018, 2019. And then the monster slowdown. I mean, this thing's humongous in 2006 all the way to 2010, 2011. I do think it's early to be calling for some big deflationary crash when construction spending and all employees in construction continue to go higher. We also have total construction spending across the board, just total construction. Doesn't matter if it's residential, uh, commercial, doesn't matter, everything. Big pullback in 2006 and onward, and we are cruising higher this entire time from 2011 up. So we're still continuing to spend money on construction in the United States here, and it's still continuing to go up. This is currencies against the dollar. So we're looking at relative strength, and we are signaling out two currencies. So Australian dollar versus the dollar, you can see the big consolidation, and we're still in this consolidation here. We haven't broken out yet. So the commodity bull market, they generally occur when you get a large imbalance and you get an outperformance. So this is back in the 2000s, this outperformance here. We had that big pullback in 2008, and then outperformance all the way to 2011. That's when gold outperformed too. Remember that. And silver. We haven't broken out yet. The currencies are not outperforming against the dollar yet. This is Canadian dollar versus USD. This was the previous squeeze into the corner of 2003, and then 03, it was just rip fest in the 2000s all the way to 2011. This is your bull market in commodities. Your bull market in commodities is weakness in the dollar because that's what you're measuring. You're measuring the weakness in the dollar against either other currencies like we are here, or your measuring stick is declining when you measure it in copper, silver, gold, whatever it is. And those things are, again, a stable unit of measure. 1 ounce of silver is 1 ounce of silver. 1 ounce of gold is 1 ounce of gold. Here's your consolidation, your 3-hump consolidation, just like this. We've got that squeeze in the corner. This is your squeeze in the corner that's occurring. And we're still within the pattern. We've got Brazilian real versus the United States dollar, the squeeze, the breakout, but it hasn't launched yet. Dollar's still strong. And this is the British pound versus the dollar, the 3-hump consolidation here. And then we've broken out of the trend line and we're doing a retest. So more than likely, we're going to break to the upside, is my guess on all of these. Here's a couple of different ETFs in relationship to the commodity that they sell. So XOP is the energy ETF against crude oil. And look what happened here. This is very interesting. We had a nice big surge higher here. And then all of a sudden we just turned and went right back in and through the pattern. And now we're kind of at that support level. So I'm interested to see where this goes next. Is there a scare? Is it just tax loss selling? What's the deal with these last 3 months? Last 3 weeks in how strong this is sold off? Are they trying to contain it? Do they not want money flows coming into this? We had a clear break here, so just interesting to see. Here is SILJ versus silver. We had a breakout of SILJ versus silver, but the past couple of weeks, we've had a pretty big pullback. What's going on here? How can we have a pullback in SILJ versus silver and in XOP? And they generally work under different market conditions. And the market conditions are somewhat opposite of each other. So you see energy go up when inflation goes up, and that's when silver and gold generally go sideways. They are they anticipate the money printing, and then they do one final last move when the money comes into the system. But if it's a fear trade, gold should be going up. So I also put in GDXJ versus gold. That's broken out, but again, the past couple of weeks, it's been a rough ride. Why are we getting so much selling pressure in GDXJ, SILJ, XOP these past couple of weeks? And URA versus uranium. I mean, this thing is down in no man's land, way down there. And you can see the big, this is on a monthly candlestick. The last month, we've had a lot of selling pressure in uranium. So it's not contained to one sector. It's commodities in general that are selling off across the board. And it's impacting silver, gold, energy in general, and even other sectors like agribusiness and other things, fertilizers. So the end of this year, it's been rough for a lot of the commodities, and they've been underperforming against the ETFs, the equities have been underperforming against the commodity itself. Here's a quote by Ben Graham. He says, "The intelligent investor is a realist who sells to optimists and buys from pessimists," says Ben Graham. I don't know if that quote is necessarily true because, I mean, it's not about selling to optimists necessarily, because an optimist or a pessimist is something that is kind of ingrained to the person. So the intelligent investor, yeah, he's a realist or someone who accurately identifies the markets and can read them correctly, but he doesn't necessarily sell them to optimists only. He's selling to people generally, if he's really good, in a market condition where everyone is, I wouldn't call them optimists, they're just optimistic at that time. There are a whole bunch of times in in the markets where people become optimistic, but they also become pessimistic too. So I would say a better thing is the intelligent investor is someone who understands the psychology of people and uses data, who sells to those that don't use data and are very emotionally charged investors, and he buys from the same emotionally charged investors when the price falls. So they're optimistic, those emotional investors, at some point, the FOMO people, and then they become very pessimistic when they see their account go down. The realist just takes advantage of those two different market conditions. Coming down, we got JC Parrots here. Mathematically, you can't have a bear market or correction of any kind without the prices of stocks falling. And while the new 52-week low lists are virtually non-existent, we haven't seen any expansion in the new 3-month low lists either. So this is your percentage of S&P 500 stocks at 3 months lows, the 400 and the 600. And there's no expansion in new lows. So everything looks okay at this moment. We'll see if it changes. He's looking at breadth here, is really what he's doing, the breadth of the market. Peter Schiff says, instead of creating a Bitcoin strategic reserve, the US could save a lot of money by creating USA coin. Or what about America? Not even an A, just America. America coin. Get some America. Yeah, America. Okay. Just like Bitcoin, the supply can be capped at 21 million. But with an upgraded blockchain to make USA coin, America coin, actually viable for use in payments. This way, we can all get rich. So I don't see why they couldn't do that. Why don't they just do America? Do America coin and create it. They can limit how much there is and actually make it used for transactions. Maybe that's what's coming. And I don't want to be using it. Bar charts. U.S. stocks saw a weekly inflow of 62.4 billion last week, the largest inflow since April of 2020. So here's the equities there. Big inflow coming in last week. We've got Nick Schmidt here. A little bit of a long one, but we'll read it. It says, what if I told you that some of my best trades didn't have a setup? No setup, no trade is me, it's a little different. If I can't define my risk, I don't trade, period. The market isn't always clean. Patterns don't always line up perfectly. But here's the rule that never changes. I know exactly where I'm wrong before I hit buy. If I can't define that level, the trade doesn't happen, end of story. That risk level can be anything: a support line, a prior high, even a psychological price point. It doesn't have to be fancy, but it must exist. If I don't have a clear exit, if I'm wrong, I'm not trading. I'm gambling, and I don't gamble. The bottom line is setups are secondary. The real edge in trading is risk management. The question isn't, is this a setup? It's, can I manage risk here? The answer is no. You walk away. The market will always give you another shot. Discipline wins always. Define your risk or don't trade. I just want to make a comment here. His risk in his opinion on these is the risk level can be anything: a support line, a prior high, even a psychological price point. That is how he measures risk. That sounds ridiculous. So a trader, I always define my risk. It's this line on this chart here. So when you study Manish Pabri, Buffett, Lynch, all these guys, they would laugh at this. This is a joke, right? I laugh at it. I look at it like, this is the stupidest thing I've ever seen. You really think that risk is just a line on a chart? So when I look at it, I define risk maybe perhaps a lot differently. Risk is not knowing what you're doing. Risk is buying something that's very expensive and expecting it to get more expensive. You have no margin of safety. Risk is buying into a cycle that is changing on you, going from in cycle to out of cycle, and you're doing it at an expensive point. That's risk. So this guy, I would say, doesn't even know what risk really is. And risk isn't something that you can really define all that well. But if you want to do well in the markets and you want to make a boatload of money, this would not be the strategy that I would deploy, because I wouldn't even say that he knows what risk really is. The traders don't. And the traders, they'll just say, well, it doesn't matter. Of course it matters. Anything that can increase your probability of success matters. So what if you had a perfect setup, a dream within 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 a dream? How do you know that you've got the perfect setup? If you don't know the valuation, if you don't know what the risk is, if you don't know any of that stuff, you don't even know that you're in the dream. There's no way that you know that you're lining up the asymmetry properly. Because if you did fundamentals on top of technicals, on top of cycles, what if you had a dream within 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 a dream? So what are all those dreams? The dream is you've got a cheap sector on a ratio perspective. You've got a cycle that's coming into cycle that's going to change that ratio from cheap to expensive. You've got a long-term chart that's turning and flipping positive. You have a medium-term chart flipping positive, and then the short-term chart is flipping positive. You have a falling wedge on the big boy. You've got let's say on the medium or some other time frame, you've got maybe an inverse shoulder head shoulder showing a bottom at the bottom of a falling wedge, and you're going, holy crap, I've got a dream within a dream within a dream within a dream within a dream. And then you can appropriately position size in it. And if it's cheap enough, let's say you've got a boatload of margin of safety. Let's say the asset value of the company is $3 billion and you're buying it for $180 million. And you're going, oh my God, look at the fundamental value in this thing. And the cash flows are starting to turn up. That's all the dreams that you can, get in there. This is like the perfect setup. This guy wouldn't know what a perfect setup looks like. He thinks that the risk level is a line on a chart. That is a problem. So I think that you need to have some technical, but also a lot of fundamental backing of it. Now, what if I said this? What if all the dreams lined up? You're in a commodity, it's super cheap, it goes off the page how cheap it is. Oil in 2020 went negative. And I looked at that, scratched my head, and said, oh my God, this is the biggest opportunity in my life. Your biggest risk at that point is the companies going bankrupt. But how can you, I mean, you can look at the technicals and sometimes they can tell you, yep, it looks good. And you also want to look at the balance sheet to some extent, just to make sure that the debt's not going to eat them alive. And if you can time it where you're buying it with max fear, that's another dream within the dreams. So you had a negative oil price, which went to the most ridiculous ratio at the bottom of a false breakdown in oil versus whatever ratio you want. You had companies that were selling for pennies on the dollar, literally. And your biggest risk was that they were going to go bankrupt. If you had a technical pattern that was bottoming, which they all did, you could have went major ultra long. But you need to understand as an investor all of the background to do it. Lines on a chart aren't going to cut it, buddy. That's all I'm going to say. Art Berman says the push for net zero by 2050 isn't happening. As Thomas Kuhn argued, dominant ideas persist until their flaws force a new paradigm. The energy transition is at the breaking point, and it's, I'll say, exposing those flaws in the new paradigm. Here is a friendly reminder for investors fixated on stock prices. Successful investing is about understanding what lies beneath the surface. You don't focus on stock price. You look what is below the surface. So what's below the surface? The stock price is what everyone sees. This is what you should be looking at. Free cash flow, the balance sheet. The balance sheet is going to show assets, debt, and that type of stuff. Look at the leadership team, the competitive advantages or moat around it. What are some of the risks associated with buying perhaps at the price that it's at? That's the valuation. Pricing power. Can they increase pricing? Or do they increase pricing and your demand just drops like a rock? Return on capital, that's generally what your long-term return is whatever your return on capital is. Optionality and culture. So look underneath just the price. The technical guys look at price and they try to gauge if people are buying something or not. And I do think that's important. I'm not saying that technical analysis isn't important, but I also think when you combine this, your chances of success, your probabilities of success will go up. You know, what of the sector, what's the average cost curve? Where's that line at? And where is the commodity price in relationship to the cost curves? These are all things that you should understand and know before you start investing. XLE, the worst month since June of 2022. There's that worst month. So this is what I do. Okay, this is what I do. I go and I look and I say, okay, where are some really bad months? Here's a bad month. How are the months around it? So before it had a pretty big move up, bad month, and then it had a pretty good move behind it. So it's kind of like volatility. But this year, this is a slowdown. Minus 11, minus 15, minus 34. You can also look before in 2019. There were some up moves, but that's a pretty big pullback there. That's a recession. But what happened after the recession? 31%. So if we were to look at this and you say, where are the best times to purchase on this chart? It would be at the bottom of multiple selling pressure moves, like ones that go a certain, couple of standard deviations off of a really bad selling pressure move. So this here, minus 11, 15, and 34 in a row, that's when you got to get aggressive because then you're going to get a big move after that 2020 move. And that's what we saw. 2021 was a pretty big year too. You want to look for ones that sell off multiple rows. Like here's minus 10 and minus 14, and we had a big 20% month in October. And then you can go up and look. We had some pretty good months all through here after that. So these reds, wherever they come up, and if they're very steep and strong, they're actually buy points. And what most people will do is they'll say, "Oh, this is horrible. You don't want to invest here." That's exactly when you want to invest, is when things look like crap. Here is Mohammed. He says, Jim Bianco has an interesting X thread on the Federal Reserve and inflation expectations, including this chart. The dotted vertical line is the first rate cut in September. Look at what inflation expectations have done. Up, 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 up. And this is the U.S. 2-year and 5-year TIPS Treasury inflation break-even rate. They've gone up when they started cutting that rate. So if they continue to cut rates, maybe it will continue higher. Here's one I thought was a little interesting. It says, big investors and corporations are hoarding cash like never before. This is unlike anything we've seen. And this is the large time deposits, all commercial banks. It's been going up quite a bit. Other times that we saw this was back here in the 2000s. We had a pretty big move higher too. So maybe we've got something going on, much like the 1990 and 2000 timeframe here. Very similar looking chart. This is a consolidation here that we've broken out of. So the consolidation here ended here in 2023. Nice little breakout. My trading strategy, you buy it here, you take a screenshot here, and then you panic sell with a loss down here. That's pretty common for most people. That's what trading will get you. If you're an investor, you kind of just hold on. I'll just say this. Most of the time when I buy something, since it's very cheap, I am down at that position at some point in the next like 4, 5, 6 months if you're a long-term investor. Like you're down on the majority of your positions at some point when you first buy them. Pretty normal. Traders try to avoid that downward move. They try to make a small upward move, but you don't make any money that way. Even if it's a 50% gain and you lose some of the trades, you make one, decent ride, you don't make that much money. That's kind of really annoying to me. Here's Intuitive Surgical. The leader maker of robotic surgery products has compounded revenue at 20+% for 20 years. What would slow them down over the next decade? I hate to say it, guys, but I was researching this company in 2004 and 2005. I bought it for a very short period of time, and look what actually transpired. Now, I'm going to say this. I was a brand new investor. I was studying a whole bunch of different companies, and this one had the Da Vinci system. The Da Vinci system is call it a robotic arm or something like that. It's robotics where it can mimic someone doing a surgery. And I don't know what the full extent is even today, but I was like, man, that's probably going to make some money because it could do things that maybe your hand can't do, because you can manipulate things and get into things where you're not constricted by your hand. You could have something where you can do some ridiculous things that a robot can do that your hand can't. And there's some other things too I think it can do now, but that was one where I saw it, but I bought it and I sold it with a very small up move. But look what transpired after that. 22.67% compounded annual growth rate. Guys, this chart, if you were to look at it, is just ridiculous from that time frame. It is in 0405, it was like, $4 or $5, split adjusted. And now it's all the way up at 524. That's a 100-bagger. 100 times your money. That is what I want to get involved in. I want to get involved in 100-baggers, 200-baggers over a 10, 20-year period. And then you don't have to worry about it. You just let it sit and go. The trading, you're not going to make that type of money. You're not going to get a 22.6% compounded annual growth rate trading. I just don't believe that. So those are the companies that I try to find. And I don't know. I saw this one, and that's something that I guess I missed. And that's all I've got for today, guys. So we'll end it there. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Discount is the coupon code. We might run a little bit bigger discount coming up for the Christmas holidays here. It'll be very short lived. So if the window comes, better jump on it. But that's what we've got for today, guys. So we'll end it there. We'll catch you next time. This is Finding Value.